I'm director of, or risk director, so I look after the lending policies, both bridging and buy-to-let, and also the underwriting schemes across both sides. I also oversee our completions team as well, and basically tackle cases.
So you chair risk code as well?
Yeah, chair risk code too. So yeah, pretty much kind of credit risk hedge across the various operational parts of the business.
You described Director of Treasury and Capital Markets in ESG. I think I've had the pleasure of meeting or working with most of you, probably with the exception of Josh and Vivek actually. So yeah,
and
we're here again.
Ian's on one of the call. He'll join us. And Ian's background is, he was CEO of GE Money, CEO of Kensington, CEO of Target. He's had servicing teams of thousands of people in his career, and he now runs our servicing business and our operations. He'll join me.
I think I like the fact you've got kind of, and the idea is to use the slides as a backdrop rather than the main focus. I think what I discussed with Phil earlier was, the idea that look, anything you guys need that doesn't get discussed here doesn't mean you can't follow up, and we'll make sure we do it in short order. More detail, I think. That probably like a decent amount of time looking at operational processes, procedures, and cash management. So that's also one of the areas that Rory and I will go into in a bit more detail, maybe than we would have done maybe 6 months ago in one of these sessions. I don't know if you want to, if it works, maybe Simon, if you sort of kick off and we'll come to the overview here, and then we can get to obviously the key bit is when we get to the structural change.
Yeah, sure. Okay, I'll pick up that. Sure. So a couple of slides. As far as just reflecting it, we've done this dance before with the bank, because obviously you guys were really early partners with us when we did Solve 1 originally. So a lot of the buy-to-let stuff you've seen before, you've lived, you've experienced it. So in that respect, it should be hopefully be a somewhat trodden path. But at the risk of going over ground you already know, we do buy-to-let and we do bridging finance. Those are the only two things that we do, both unregulated. We do this CBTL, we have all authorizations and demonstrations for that. And that's it. And then buy-to-let represents the significant majority of our business. And I think that whilst we look to grow our bridging and have had some success in that, we have had regular more success on the buy-to-let side. So I think we've now originated since the outset. I'm just trying to remember what that number is I had this morning, so give me a sec. Okay. Since launch, BTL, 2.5 billion for BTL, and about another half on bridging. So we've originated 3 billion in the 8 years, 6 securitisations in buy-to-let, which also speaks to a decent track record of building up and paying down the rest of the shots you guys want to hear.
Yeah, and that last one, probably importantly to you guys, that last transaction we did represent the 2 billion of issue milestone. So, again, I'm conscious you want to see it rather than some to ramp and pay.
Who's driving this? Did you jump to this slide?
Yeah.
To resume under the time line one.
Good way.
That's great. Thanks, Alex. Yeah, so just super quick then, without wishing to slow us down. Yeah, a lot has happened in 8 years, as you would imagine, especially with 3 billion out the door. We still remain quite a lean company. There's a good 60 heads. We're in the process of finding some new offices. We've got down with legals now to move in a couple of months' time as we grow. But there's been a journey with some really good partners that we've stuck with throughout the us, as well as our comfort with them, especially considering last last 8 years with COVID, cost of living crisis, the war in Ukraine, and currently post MFS. So we've done 6 securitizations. I think that's probably, we've got a piece on funding later in the deck. Specifically, we can get into a bit more detail. But just to sort of show that the journey here has been built very carefully, very solidly over time. Sorry, Alex, you can come back to that slide. So just in terms of some headline numbers, last year, these are some numbers just, our trajectory in the Q1 is even stronger. But 2 securitizations last year, that was something, all new issuance. It wasn't like it was a recycling pooled loans, it was all new. 725, I think, of origination in the year. When we first did business with you guys, we had a handful of brokers. We very much handpicked those to work with. And that's worked really well. And over time, we've grown and grown and grown our database. We've grown our sales force, our marketing team. Still, very deep relationships that we have with people who we know, who specialise in our space. So a big increase in brokers is part of our growth trajectory. And last year, 20% growth year on year. And that's very much, I think, our CAGR over the last 5 years has been about 26%, something like that. So it has been a very consistent growth rate. I guess when you're starting on a small base, relatively speaking, it's easier to nick the market share than it is if you're a NatWest looking to do it, because a couple of 100 million makes no difference to your volume. So it doesn't make a lot of difference to us. 2.7, so this is a bit out of date now. So that's BTL origination, that's right. We have sold some assets. We have a forward flow arrangement where it identifies loans that are less easy to servicing, so a loan. And we've done a little bit with that. And then what else? I think we covered everything else apart from profitability, which, for 2025, 2025 profit before tax. This is not audited yet, but audit's just about starting now. We think we'll be in the region of about 12 million, and it's been a very consistent, profitably growing business. Right. Here again, this is a slide that's you might have seen before, some of you, but the drivers are, on the origination side, I've covered off the brokers that specialise in buy-to-let. We don't really want to get the occasional user who stumbles across a friend who wants to buy-to-let and just going to do it. We're interested in experienced landlords who have been through the cycle, who've got large portfolios in the background, lots of excess cash flow, and it's the brokers that are deep in that we chase. The loan size has been very consistent over 8 years, always around 400k mark, plus or minus a little bit. And I like that because I believe that you've got 6 figures of equity in every transaction. Our average LTV is consistently been just about 70% or something. You've got a decent borrower with experience. You've got cash flows from an outside portfolio. You've got rental cover on the BTL loans, which is since inception and even through the higher interest rates, about 175, 180% cash flow cover. And you have personal guarantees. So you layer all those things together, you've got a series of sort of plan A, B, C, D, E. Plan A is that this loan performs because it's a decent asset with a decent tenant and a decent landlord who's got decent cash flows. But if things don't work out, we've got equity and we've got PG in an asset that, and the other thing which I'm doing Stuart's done, that whenever we do a valuation, which we do on every single loan, we always get a 90-day valuation as well as the day one. And if the delta between the two is 20% or more, we don't lend, or we seriously knock back the LTV, because that gives us an idea if we had to get rid of it quickly, what would it look like? It's not bomb-proof, but it's not something many lenders do that we've always done it. On the funding side, you're up there. NatWest Markets, again, you know this, you were part of the sale of HSBC and BNP for a while until was one. So you guys now run the bridging piece, and Santander are in for the other BTL warehouse that we've got, M&G to the MES, and then the MTN bond program. Adrian can cover off. It's just a small bond program that we run, raising equity. Six securitizations, agencies we could add to that list. I think DBRS are now on there too. The credit performance remains today for BTL. It's less than 25 basis points over 30 days down, which is, not bad, bearing in mind where the industry level is at. And it's been consistently, good versus our peers. And, partly that's because we do the servicing in-house. It's also because we target the type of borrower and the type of, asset that we do. And then data, obviously reporting is very, very important. We have a data warehouse, we have a head of business intelligence. We have to report to everybody, including yourselves all the time. So Adrian's team does that along with Laura's team. And in all the AVPs we've done, I don't think we've ever had anything less than the 1% material error. Not even material error, no material errors.
No, I think Kristen, we've just had good results for the AVPs. The few times there were minor things, they were minor things. I think we, but I think also like on the performance side, it's probably worth pointing out that that's why we were able to move to an SDS public issuance back in November, because it's not a jump for us in terms of credit. It just happens to be the credit we already do, and that's why it's also quite nicely aligned if we're able to make this warehouse SDS for the same reasons. And you'll see later on, when you look at our average LTV, we're not about sort of aggressive lending, we're about sensible lending, but doing it well.
I think I covered off this by default, sorry about this. That, so the top left-hand boxes are PBT over time. And interestingly, during those last 6 years, there's been some really choppy periods where some of our peers have shown brackets around the profitability where they didn't hedge, or they, just basically were dependent on flow programs only, where we will do a whole bunch of reasons. And so we've been very, very consistent and shown really good growth, and expect that to continue this year. Portfolio has grown in a very similar way. There's been no big hockey stick. It's been measured. We've kept the business. We've grown in lockstep with the volumes, almost a just-in-time basis. Just making sure that we are keeping it as tight as we need to, but at the same time being quite ambitious on our growth. The company is just under 70 million, probably is about 70 now, actually, as we sit today, but in that sort of area. NAV.
Oh, yeah.
In terms of equity put in, but mostly retained earnings. Probably about half and half, actually. Half and half, equity and retained earnings. And then just looking down the BTL piece, I said something already, so just under 1.8 times cash flows, just under 70% LTV. And I think the originations number is a bit out of date, but so actually that's not that, no, it's right, 2.225. On the other side at the top, I mentioned that we keep it quite lean. 43% cost income ratio is consistently being like that. And there are days when I think it should be 60%, because it feels like we're all doing three people's jobs, but it's good. What that means is that when times have been tough, we've had a very decent balance sheet throwing off cash flows for us. We've been able to maintain our margins. We've had a lower cost base. We haven't had 3 offices in different locations with 40 developers to fund or anything else. It just means that the company is much more resilient to shocks, and that's how we like to do it. And just on that, we'll get to it a little later. We don't invest. We do invest in tech, but we license it. So the philosophy is to rent and not buy. So our systems are all tested systems that are bespoke to us a little bit, but it means that we can keep our suppliers on their toes if they're not keeping up with the market trends, you're in for a 3-4 year license period. With the pace of change that's coming on through AI and everything else, you don't really want to be investing, we don't believe, in a system that, you have to have a whole bunch of overhead to support it and to keep pace with those changes. It's just that we'd rather someone else did that. So that's another reason it helps the cost income ratio. We've got some AI in the process. We've got a whole bunch of things. We're a digital business. There's no paperwork. There shouldn't be. We've got to stick it on desks. Actually, our compliance head comes around and does clean desk checks every now and then and sends out a report. So you don't want to be on the report. But when we move offices, it does make it a lot easier because we've got literally nothing to take across. And the bridging portfolio, you should know all about. So we won't talk about that today, but that's actually consistent. Right. So structure. So the left-hand side shows a current structure, which is the historic one, where you've got Cabot Square Capital, who invested in the business, which was called SPF Private Clients. It's the old Savills financial services business, and took 2/3. The existing SPF management team kept 1/3, and we built Lenco out of that coming together. We sold the broker 3 years ago to Houghton, and now Cabot's investment is only in Lenco. The shareholdings haven't changed at all, and the two top boxes down the middle in sort of pinky colour are holdcos, and the operating business is Lenco Limited, and it has a servicing sub Lenco Mortgage Servicing Limited. Down the left-hand side, you've got the SPVs, which are relating to funding. So you'll see Tolls number 2 is where you guys reside currently. Tolls number 1 was where you originally, well, it's just Tolls Limited actually, but we called number 1. That is where you originally were. Number 3 is Santander, and then the Atlas is down that left-hand side. And we've done what we said we would do. We've called 2 now. One just earlier this year, but another call later this year. It's gone extremely well. The reporting on that and all the processes attached to it. And on the right-hand side, this is what the future will look like, assuming that this transaction closes, which is what we fully expect it to do very soon. Cerberus is we've troubled you for a change of control waiver already on this, but they will be 100% shareholder, so there will be no management shareholdings at all. They're looking at a very long-term hold for the business. They have as always with these businesses, they have these funky, like Prometoria, Lux Holdings 121 style. It's not the most catchy go-to-market name you would choose, but that is the whole code that they've chosen to use to own this business. Otherwise, everything will stay the same beneath it, and that, as I say, that's the change. Except, of course, you are going to get, Cerberus has got, I would argue, a bit more firepower in Cabot Square by a multiple of some big number.
I think the other important thing to just focus on this page is simplicity. If you look at and get the backdrop of some of the news in the last few weeks, it's been around complicated businesses with complicated structures, complicated moving to cash, and absent obviously we don't see Toll 4 in there yet, but and that was 26-1. But all of our facilities are structured in that way. The only things you kind of don't see there are 2 flows, to a forward flow and to an NPL bond program. And I think the fact that Lenco's entity structure is so simple is also helpful. But the only accounts, for example, where we hold what we call our money, are the ones associated with the Brighton boxes. It's quite easy to do a cash flow. So, Rory will talk more later about the kind of detailed checks that we do every year around that.
And the way you sorry for the point, please go ahead.
No.
And the way you set up lender of record is still Lancome?
Yes.
Yes, okay.
Yeah, it was quite important to us in all of our funding agreements for us to do the legal title holder because, amongst other things, that's your reputation as well. Service those loans and that legal title. So yeah, that's the important. And the service of record is Lenco
Yeah.
So I was just going to ask, apologies if I'm jumping ahead, but would this be a good opportunity to maybe update a bit on the circles acquisition situation happening?
Sure. I mean, yeah. I mean, we are hoping to sign the SPA imminently. There's a couple of little bits and pieces, as always, on these deals. They take, everyone's an optimist. Next week, and suddenly it's next month, and it takes ages. I think we're very, very impressed. So I was in cool positions for the so we just want to get on with it. So we're all a bit exhausted by how long it's taken. And they're really, I don't know if you worked with them before, but they're really excited to grow the business. I think it's going to be really good. So short, but then I'll
Today, tomorrow.
So I think we've covered off everyone here, really, to be honest, in the interest of time, but not the most diverse group of people, but it kind of is how it fell as we grew the business from scratch when there was just 2 or 3 of us and added people. It wasn't any other reason. And everyone has stuck with, we've got a very, very good, sticky senior management team throughout with a really good background. Because when you start a business, it's quite hard sometimes to get people in who want to take. Is it risky? Yeah, probably is. So getting people with the seniority that as the company grows, they've done it several times over in their career is really, really helpful. So when Stuart joined us, which was shortly after we launched, he and I were sitting there writing the lending policy. I'm in that for a long time, and things like that, which and as the company grows, you've got that experienced bank to call upon for all the other stuff that happens, and that's what we have here with this group. And then this is just how it sort of pans out in terms of structure. So Stuart has most of the people, probably followed by his sales, and Adrian and Rory rapidly catching up. And just to finalise my bit, I think we only deal through brokers. We have had some direct business, like 1 or 2 cases in the past, but strictly on a non-advice basis, strictly caveated. So we just don't do it at all anymore. Intermediary only, we do a bunch of DD on those brokers when they come in, which includes them signing a 5 or 6 page introducer agreement with us, which gives us audit rights, clawback rights, etc. We check their regulatory status with the FCA, we check with the ICO, we check the company's house. We do all of those checks on every single broker we have added to the panel. I think otherwise things are pretty consistent.
So I was going to suggest move back with 1, if you don't mind covering this one. There's a question on the agenda around broker fee structure.
Yeah, well,
that, but also later tax digital renters right.
Eventually, that one.
Yeah.
So what's the second part?
Well, I think you guys are basically saying what's our fee structure?
Yeah.
And then also, do we anticipate any impact on account of making tax digital and all the renters rights out there?
Okay, well, the first part, dead easy, it's 0.75%. We've paid that since we've launched. We haven't changed it ever, we've not increased it, we've not reduced it, we've just never varied. It's always 0.75%. It's in the pack, okay, in terms of where it sits, and it's paid only at completion. Any fees that the broker charges the customer are outside of our visibility control. Our offer letters clearly show all of the disclosures that we require, especially in the light of the car finance disclosure issues, and the customer signs the offer, which means that they accept those are the fees. And then in terms of, what was the second part, sorry, third time last one?
The Renters' Rights Act, the Making Tax Digital, do we see any challenges?
I don't think making tax digital, I'm not sure what would be the impact. I've certainly not seen anything that looks like an industry flag through UK Finance or anything else that suggests that's a concern, and I haven't heard anything from our brokers. I mean, do landlords pay their taxes? My starting position is yes, they do. you're giving up a lot of information to a mortgage lender when you fill out an application form, and HMRC has a right of access to that. And so you'd be pretty daft to say, on the one hand, I've got this portfolio, please lend me the money, and not tell HMRC the same story. But it's right. I think it doesn't really make a huge difference. Landlords, our landlord base don't tend to be, well, I've got a bit of cash, I'll get a buy to let. I help my pension. It is what they do, and they've done it for years, and they wouldn't know what else to do if they didn't do it, kind of thing. They're at a scale where it kind of helps, it takes care of itself. So that means that they've got the administration sorted out, they've got their managing agent sorted out. So now that the fact that the tenancy is going to be more flexible in favour of the tenant, that they can't be discriminating against the type of tenant that comes in, they just adapt to that. A lot of people are making changes now ahead of that legislation coming in, because what I'm hearing is some landlords are actively, doing the sort of forced evictions now just to tidy up ahead of it, which is a consequence that politicians probably could have seen coming. But you give that another 6 months, and it really doesn't seem to be causing any of our borrower base a concern that says, I'm fed up with this, I'm going to leave the industry. In fact, we're seeing bigger and bigger volumes coming through. I think where it has impacted is in the occasional landlord that's, we sort of refer to them as the dinner party landlord, that just has one or two that says, actually, this is just too expensive now. All the tax changes, God, I've now got to accept pets into my lovely flat that I can buy anyone. For example, that's what I think we're seeing at the head.
And is there any second order impact as a result of exactly this, i.e. those non-professional landlords say this is too much, it's not worth it on a net basis once I put everything together, let me try and sell this. So then you have all these properties going back into the market and then impacting valuations, i.e. a second order impact on the portfolio.
I don't think so, because I think it's been coming for quite a long number of years. So if you think about the changes to stamp duty, the changes to tax, so for example, we have about 80% of our business comes in the form of an SPV, specifically for the loan. You go back 7 or 8 years, we've been a lot lower before they started making the tax changes. So they're adapting to it. I really don't think it is immaterial. And so in other words, the people that have been pulling out over time, stamp duty increases. The last two governments have been almost anti-landlord in a way, but it's been right. But if you look at the UK finance stats, the share of the BTL market that's specialist, which is a weird term, which means nothing really, has grown, and so that's normally defined as multiple property owned. So it feels like that sector, which is our sector, is seeing opportunity. So what we've done successfully with you guys a lot is the bridge to let product, where someone sees a property, it's a probate sale or something, and they say, right, I'm going to buy this, it's taxi, you won't get a mortgage on it. We'll put a team in 6 months' time, we've turned it into an HMO, we've got the licensing, and now we'll take it out as a buy to let. So we do a lot of that, which is really good source of business actually.
In terms of your open network, what's the kind of distribution? Do you have a large exposure to a few names you trust?
No, we've got as in any distribution, you're going to have. It's not going to be a flat line. So we will have some concentration on top 10, on top 20. And there's a long tail. So what I get frustrated about is we've got a very large database, not enough using, right? So you're always wanting to get that penetration. That's where the growth opportunity is. So we hired a couple of people whose focus was to get some of the big networks and clubs on distribution, and they've been really successful in that. So our high-level distribution number is big because once we've got that in place, then actually you can dial up and down your pricing to drive volume because it's more price-sensitive distribution than a specialist piece. But it's also got to be retrieved, it's got to be followed up on, you've got to get the repeat business. So it's not, it's got a lot of art as well as science attached to that. And what we've decided is that we've got limited resources. Let's not try and be all things to all people. Let's go deeper with the thousands than necessarily try to do that for 7 or 8 apps. If that makes sense.
There are lots of examples of lenders spreading themselves too thinly in that respect. You just end up with a bunch of underwhelmed brokers, or you catch fire of your operation.
We won a few awards on our own. Best Specialist Private Let, is it 24 or 25? I think we've just been nominated again for it. So, you know, something is working. Because we don't put ourselves forward, which is always nice. Cheers, no, it's fine. So I mentioned about arrears. This is just over time. And, you know, the hiccup in 2020 was COVID loans, and the book was tiny. We had 17 loans that were not in arrears, they're on payment holidays. And so that shows there. And nothing, I mean, the line is so flat that any arrears look like a big uptick, but actually it's from a very, very low base. And there was a small uptick at the beginning of 24. We had a small cluster of borrowers related who had a big life event being resolved. And as I said, the position is something like less than 25 basis points of over 30 days. So it really is very, very good. 28%, beg your pardon. No, end of that, points away, this one, so I told you that. It's a gimme. Thank you, Mark. Yeah, maybe that's what it is. We'll pretend that is. So yeah, it's been a good story. So, you know, data points is just so important on the story. You know, whether it's audits that we have, whether it's, you know, arrears is a really, really big data point for everybody. And my sort of layers of mitigation that I've mentioned at the beginning, the LTV experience, and everything, I think contributes a lot to that. I think that's still me.
I was just going to say that the purpose of putting this slide in was to sort of, it was just a landing point for your agenda item 3, which was talking about the RAND, sort of what our product mix looks like. I think you wanted to cover kind of interest rate expectations, maybe touch on equity, as well. But I don't know if it's worth you just talking about the first time and the consistent sort of production we've had over the last couple of years, because I think it has been consistent.
Yeah, I mean, the last 4 months, for example, have averaged well over 60 million of ETL a month. Completions last month was 69. So, you know, it's working for us. You know, for all the reasons we just said in terms of opportunities out there with the distribution, we just hired a senior marketing person, which is a big step up in terms of capability for the business. So we funny enough, we also think there's going to be some opportunity in this disjointed market.
Being archived.
So we think
Afternoon, project.
Good to hear from you. In the market where others are going to be, it's going to be some distress. So it's a good opportunity. So yeah, that's our growth plan. I think that's in line with our plan that we share the service, our current shareholder.
And I think just going through these points in James right through, I mean, firstly, sort of competitive positioning and fair comparison. I think it's worth pointing out, Simon, Alex and I meet every Tuesday. We look at the competitive position, and we do benchmark ourselves with peers formally. I think what definitely has transpired is, you know, our business model allows us to maybe attract 20-25 basis points cushion to some of the guys at the top of the table, because a few simple things. I think the first one is we're always present in the market, and we've not been volatile in the way we price. And then to boot, the people who come through the pipeline have had good service, and that's been consistent. And I think by just having that, if you look, that is a consistent pattern of origination, and that I don't see any reason that would change. I think Simon mentioned Cerberus are ambitious, and it would no doubt grow over the next few years. But in the same way we've grown today, which is in a thoughtful but assertive way. But in terms of ramp, I mean, you can see that there. And I think the key thing to draw out there is there aren't any periods where we expect to be below 50 million a month in originations. And obviously the interest rate environment over the last 2 months has been unkind. But I think that rigour of meeting every week and constantly hedging and constantly being on top of it has actually meant that we've been hurt by the interest rate environment far less than maybe a number of our peers. So we expect to keep where we're at. I think in terms of the type of product, I might have argued 6 weeks ago that we were starting to see an uptick in 2-year fixed, and we might see lots more 2-year fixed come through the pipeline. And then the curve just kind of inverted itself and showed that actually, the likelihood is that 5-year product is going to be the dominant product.
I don't think these numbers are right, because we did 69 mil BTL in March, and we did 58%, 68 in Jan.
It's just prior to that.
Yeah, that's just about that. I was just leaving out there. So the numbers, I guess, what I was about is correct. Those numbers make that a flatter profile than it might look.
Probably worth highlighting as well is the numbers that we've been originating both last and as those Q1, with big numbers that Simon mentioned, have exceeded our plan, which is ambitious in the business. So we're outperforming an ambitious plan. I think we're almost a month of budget origination ahead of plan, for Q1. So,
Yeah. Okay.
Did you have any more questions on products particularly, or just want to move on? And I think it's very, I think what I could also confidently say is if you look back at the last 4 or 5 hours transactions, the composition of those pools is very similar.
Yeah.
Deal in, deal out. The adverse profile is low, the LTV is very moderate, the affordability is strong, and I think, even in the current environment where yields and rates have been higher, the affordability is against the backdrop of people paying more, so it's quite quite resilient. This piece of work is something we'll share with you, because I think the intention is we've had Interpath in for the last couple of weeks that we're doing an AUP for public securitisation, so it's a 1991 AUP. But we instructed them for an enhanced scope. As we said, look, we're conscious that lenders are going to want an understanding of the way we deal with double pledged risk and make sure that they're insulated from it. And what we basically asked them to do is, rather than just give them the securitisation pool, we also gave them our entire pool, which is, I think back to your question earlier, the entire pool for which we're legal title on. So that includes loans we've sold to third parties. And what they've basically done is the following. They've gone and done a 99-1 rate check to make sure we've got registered legal title across the whole pool. And or there's an application for people pending. What they've also done is then, once that's established, they've then done a uniqueness test across the entire book to say, there are no duplications within that portfolio. And then the third piece of the puzzle is they've also got, we've kind of done it arm's length, we've got cash managers to send them all the investor reports from the public deals and from the private deals. And in the case of flows, you've got flow providers to send the balance with them. So they can match those pools of loans back to this pool to make sure we're not inventing loans in our day. So the whole thing reconciles together. And the idea is that we will make, I think we'll set up a separate engagement and we'll give you access to that AUP, including this. What we've also done is we've entered into a partnership with Euro ADS, who are actually looking to develop a product that does this on a data-driven basis. You know, they're obviously across all of the public deals that are Bank of England eligible. So they're also come back Thursday and get us some prelim results, which basically said the whole book was unique, absent 24-fold positives that Steve actually subsequently checked, which we all have applied for. So I just want to, again, I think it's quite important in the current climate to just share that piece of work.
And in terms of that cross check, are they looking for, say, the legal title ID, whether it comes up across different pools? Do they look at property addresses, or do they look across different fields to see if we look at these 3, 4 different fields, do they come up in?
So if you've established you've got a title ID, then that's really helpful because you kind of don't need to go anywhere else with that. Great, I've got a property and I've got a charge over it, and I've given it to you, and therefore you've got security. And so because I think to frame it, like our saturation is like it's quite high. Like in one of the pools, it's 95% already with title ID. I think the lowest it comes out on the pools is like it's quite strong.
But the balance is always pending.
So again,
The balance is pending, so you're registered or pending, you haven't got a gap.
yeah, there's no scenarios where somebody has a tentative investigative title. It's just the latency of the average. Yeah, it's
I think I for you guys. It's and yes, one will come through 6 months, 9 months. But yeah, the delay is so right across the piece. So you know, obviously pending has a status attached to it, which means that you can't then put something ahead of you if you're pending. And the other thing is we do is we've always kept a really tight a panel of conveyancing solicitors that always have to act for us, like fewer than 10. And as a consequence, we've got quick visibility through to who we've got acting on our behalf, that they are quality, that they know what they're doing. All those solicitors, sorry, Adrian, sitting in under here, have their they do their checks with LandReg and the pending titles on a very regular basis to make sure they're all coming through. But that's not all you can do for, essentially, you're right, Henry, it's a flawed operation.
What title did you get within a few weeks?
Yeah, there's this thing called so what is interesting from your question, that's really interesting. The check that your ADS do is actually done in a very different way. So you come at the same problem in two different ways of looking at it. And they refer to something called a UPRN, which I'd never heard of until 10 days ago, which is a unique property registration. So we've kind of we've tested the unions twice, and both times got cash managers to send the thing, sort of on that.
What do you think the second quarter of the in the NFS on the market is? Do you see people exiting the market? Do you see funding costs going up?
Well, I think it's been quite significant, actually. I think that there are some lenders that have got exposure to NFS who are, and I've got to be respectful here, who are risk off, and they're top of the house has got a risk off view. So some of Netherlands has spent a decade or longer building up their presence as a funder, as a bookmaker, and they would be really, really big positions. And now top of the house is saying, Rob, and that's going to be 10 years worth of work that's off. So I think, but there's only a few, and equally there's quite a lot that are risk on. We see this is sort of over the NWM. I think if you were dependent for all of your liquidity, you would probably feel a lack of excitement about engaging. But someone gone public, Wells, Barclays, definitely said they're not going to be playing in the market. Barclays have done that quite a few times over the last few years.
I think it would be, my suspicion is that we felt more in the bridging sector and the minor player sector, because it's a couple of things. I think hopefully, I don't know if you saw this after years, classified assets in terms of risk grade, and basically say, well, bridging's higher, price to that is probably the lowest risk grade, because you can find the collateral A and B, because it gets securitized, it gets churned. There's no place to hide it. It's cash flow. But I think I did a panel with Guy last November, and there was a guy called Johnny, the big Daniels, who's the head of the BDLA, the bridging organisation, and he said there were 400 bridging lenders in the UK, of which most of them have got 15, 20 million pounds or less to book. And I think the challenge is going to be that those guys are going to find it very difficult to tap into liquidity. You guys are no doubt going to be looking 2, 3, 4 times before their operational processes that they probably can't afford to optimise. I think for us, it probably creates an opportunity.
Yeah, whilst going like spreads, no cost at all. In fact, all been maintained, and certainly the capital markets is looking very positive in that respect too. So we don't think so. Because I said again, it's limited to a few banks. What will happen is what we're doing today, and the sort of warehouse DD sessions, ADPs, which, if I'm honest, have been fairly relaxed over the last few years in terms of they rely on securitization to show and evidence that it will pay down if it up again. I think that will be there'll be a period of time when we expect to have a lot more of that focus, which is fine. But otherwise, no, I think it's all very much game on. But MFS is really for a failure. It was a big one, and has caused a lot of that. Really, but it's only those ones that have got the exposure. We're seeing some. Ask your question.
Yeah,
Great. Thanks.
So if I may pivot on that question, one of the things we are keen to understand is the underlying mechanic that leads to this opportunity. So to the extent where you can share about the potential, competitor who's sort of not really stepping on the buy-to-let, that contextual information will be really helpful.
I think what I might do then, go to the funding slide.
I can't jumping ahead.
No, it's fine. I'd say you feel free to direct it to you guys, which is your session. Look, there's a few things here. I think at the moment, if you said, maybe describe your funding structure, let's say we've got 2 buy-to-let warehouses, bridging warehouses. Obviously, you know about the latter. The other two, I think what is also sometimes more complicated is when you have multiple lenders in the facility, it's complicated, right? Because it's a bit like painting the Golden Gate Bridge. By the time you get to where you need to be with one, the other's pivoted, and things always take an edge. And I think where we see ourselves getting to in short order is we'll have 3 buy-to-let warehouses, and what we're looking to do, the same as we have with you guys, looking to 3 times 300 million accordion. And then that right sizes us for a number of things. I think the growth aspirations under our new sponsor, but it also gives us some redundancy and diversity in that funding platform that two providers kind of don't have today. I think to probably address what was probably somewhat of an underlying question is, you know, there are one of the lenders is, I think the best way to describe it is probably a pause on the UK market, and you know, we see that, you know, that facility in any case is due for a renewal. So I think the plan is to work with you guys to initiate the project. And then what will happen is we'll get to the public securitisation in a few weeks' time. That's very timely because it presents the opportunity then for us to do, in a very simple way, do a full takeout of the facility. Most of the assets going into the public here, some of the assets will come to you. And it's a very clean, efficient way to do that from that time. I think just trying to see anything else I probably want to talk to you on this page. I think Simon had mentioned, and I might have mentioned that the book flows. So I think personally, what I would say is that our primary funding tool, our primary aspiration for loans we have them on our balance sheet. You know, they're our loans, we believe in them, we like the credit risk on everything right. So our preference is if we have the capital and we have the right funding tool, we keep them all ourselves. What does happen with buy-to-let when you get the opportunity to fund a large portfolio? There's a case study from last year. We did a £24 million portfolio. But there's no way I can absorb £24 million into the next public programs to concentrate on. But what we were able to do was absorb about half of that, which we then cycle throughout securitisations, and we're able to sell half of that to the flow provider. Now the commercial win for us was that if we'd not done the 24, we would have done 0, because the landlord wanted a bulk execution. So I think that was the whole rationale behind that flow agreement. And similarly, you know, they were able to take larger single assets, you know, 3, 4, 5 pounds, where again, if you go to a rating agency and look at, you know, granular diversified portfolio methodology, the £3 or £4 million claims don't work. So that's why we did that. You know, on bridging, we've got a bridging flow there. Now, if we think about like how much of a competitor is that to NatWest? We sold them 2 loans, so it's not there as a competitive funding tool. Its purpose is simply for the odd loan that doesn't quite fit the warehouse. And to be honest, you guys have, through being flexible in the last year around criteria, you've caused that to be less useful than it might be, to be honest, in a good way, because I think I think that's the point though. You know, if we're writing good loans and you see we're writing good loans and you want to give us credit to warehouse them, then it all floats. So the chances are that facility might grow a little bit in the course of the next 12 months. But again, I think our primary intention is to fund as much as we can on our balance sheet. And I suppose the last thing on funding to draw out to you guys, because I think it is important and it shows our stage of maturation as a business, is I think it's about 18 months ago now, we initiated, maybe a bit longer, this MTM program that Simon mentioned. And what that is, it's a bonding program. It's secured against loan value by Hong Kong gap. But I think what's interesting with that is it's a program you could only launch if you show very solid, dependable PDP over a period of time, and you had a pretty uncomplicated business that we to look at. So what that is, it's high net worth individuals and family offices and small businesses that tend to want to deploy their surplus capital or their investment capital in these sorts of programs. So what we do, we work with a company called LGB who syndicate, just like you would on a public program, but smaller. And what we do, we quarterly do issuances of smallest, I think we did was 1.8 million, and the largest was 6.5 million pretty recently. So, but I think what's important about that is it shows another source of belief in the business from investors. Any questions on funding beyond that? I think you know about the public program, but you to go to Mark 2 for STS, and I think that STS. I suppose if I'm empathising with your position and thinking, well, how does that impact the cycling of the warehouse? I think what we did find interesting stat was we reckon we got 200 million additional orders last time from bank treasurers that we wouldn't have got as a consequence of the STS. So what it does is it creates liquidity and demanding senior borrower staff.
Sorry, whether under the new Cerberus ownership, whether they've given you any steer as to how that might change or what their aspirations are in terms of your funding lines?
I think broadly, I mean, what I would say is we did a bunch of management presentations back in the summer, Daniela, and I think the feedback they gave us then was, we like your funding structure, we think you've got quite a robust, diversified platform, and obviously that you want to put forward and they thought they might want to buy the business, so they're happy with that. The early indications we're seeing is, number one, I think nobody said, they don't like the idea of the public programme, and I think all the sensible proposals we've kind of shared with them today have been warmly received. I don't know if you that's on.
No, 100%. I mean, we talk to them on a daily basis and update them on things, so they're aware of having this conversation, for example. I mean, to be honest with you, their view is you're running the show, just keep us involved. They'll try and add value through relationships, through leverage versus other experiences elsewhere that they know and things that they can do. But they're very much about growing and helping us get there. So it's entirely 100% constructive outlook, but entirely also no change to cap markets or anything else that we've got.
I think the mutual benefit for us and you in the long run is that I think they do have an aspiration for us to continue to grow our bridging book. So outside of today, definitely that's an area where we're going to look to really inject some energy.
We've been capital constrained to a point which is not or it's too so yeah, 100%.
So one from me. If I are sort of plan utilization of our for, so for example, 16 million of origination every month is split between the three warehouses, and also if a public traders call, is that going to be split in one term or split?
I think why don't I just talk to kind of like our behaviour over the last 23 years and the way we've operated the funding and that point of view. I think firstly, we've tended to more or less equal load balance the funding between the various warehouses. And then what we do, we sometimes cycle it. It might depend on timing, sequencing, where we've got to with one warehouse versus the other. The use
going to be a lot easier about a relationship with you guys is you've expressed an appetite for us to do regular smaller increases. So you're going to make it easier for us to grow the portfolio in a sensible way without running lots of undrawn liquidity. We've got that same setup with one of the other warehouses, and basically sometimes every week, sometimes every other week, we'll consume 10 million and we'll request an upsize of 10 million, and it works very well. And we've been constantly in the high 70s, haven't we, in terms of our utilisation. for probably the past year, there's always a bit of a lower level of utilisation after a body deal. Regarding the call, I think I've only got 2 examples so far, and actually one went into one warehouse and one went into the other. And that was down to, again, that was just down to a conversation, around where we were at capacity. And it so happened that with one of the warehouses, we negotiated an extra large volume capacity, and it made a lot of sense to probably ask her to if we want. But I think, but the reality is, as we run up, we've got a call in October. We'll start, we'll start conversations with you guys early. We'll let you know our intentions, and then we'll agree an action plan with you guys in that way. Does that kind of absolutely? Thank you. I think what I said to both the Janet was what would be great is to initially to say, well, look, get you credit approved as we go through the call yet. Look, if there's an opportunity and we could, for example, it makes sense for you and us to get 400 labour.
Wanted to do that, otherwise then we can talk about it. But I think 300 seems like a sensible size for our business. Anything else on the funding side? I'll think otherwise I'll let it just go.
Just on power number 3, is that going to still be buy-to-let and bridging? Or is it planned just have separate buy-to-let for the 3 and then one bridging warehouse?
Yeah, that bridging there is literally the most we've ever had in this company.
Okay, yeah.
And I'll be honest, its purpose was it was to create a bit of service capacity from time to time if we had concentration challenges in your warehouse. What's actually happened is recently we realised we've now got capacity in total too. So I think we moved across last week. So actually, as we sit today, there is no bridging.
Okay, that's an answer, but yeah.
Oh, that's probably how it will stay there for all as well. So.
Yeah, I think it's, to be honest, the asset moving assets around is quite challenging. And I think, it's not the primary focus of today, but I know you guys have expressed an interest in tweaking limits, tweaking kind of the facility on forward too. So I think once we've got this out of the way, we'll reignite those conversations. And I think we need to renew. And I think where you said you expect to be able to go with this is completely aligned to where we need to go. So I think as I say, that's you can come back next month and we'll look at that. But I was just going to ask on underwriting servicing, is there a particular direction you guys want to go, or just stick to this overarching kind of summary?
One question I had, again, it's all linked to the current, no hiding the current background and story. If you could touch a little bit, because obviously I think you said that about 80% of your originations is held by an SP, a corporate entity.
Yeah.
And it makes sense, right? And how do you look at those in terms of identifying, the UPOs, the camps and the checks, and then in terms of monitoring, when you look at your exposure across the book, whether you look, well, if the SPV 1, SPV 2, SPV 3, but in reality I have a common party across the so if you tell us a little bit around that and how do you analyze it and your checks there?
Yeah, that's a good point, really, because clearly we do lend primarily the majority to SPVs. That's just the way they do it. Just for tax purposes more than anything, that's what drives it. And so it's important for us to really understand who we're ultimately dealing with. So we will do a search. We do credit searches on the SPV. Most of the time, it returns very little information to inform just to hold that line. And then we'll look at the shareholders and directors of that holding company, and we'll also do searches against those personally. So we also like to see like the structure, because sometimes that SPV will be sitting in another structure as well. So again, we'll look individually at the individuals that within each of those entities as well, just to see who we're ultimately dealing with. So there's a lot of due diligence, both in terms of the onboarding checks, like the ID, KYC, all those individuals will have searches carried out against them. If there's anything that flags up in terms of sanctions or PEPs, and that's immediately referred over to our compliance team. Most of the time they're kind of false positively in terms of the name match that might be very similar to someone that's got some negative publicity against them. But yeah, that's in a nutshell how we look at them. We will look through the SPVs. And not only that, but I mean, our whole underwriting approach has remained quite consistent. Some might say sort of boringly consistent in that the main priorities are around affordability and the experience of the individuals that we're looking at. So, you know, and how that comes together really is that we'll look at their wider portfolio as well. So as well as the affordability on the loan we're looking to lend, we look at their outside portfolio. We'll see how highly geared they are on that. We'll look at the types of assets that they typically hold, because lots of the more experienced landlords will have moved into like HMOs and multi-unit blocks and all that kind of stuff. But especially on something like an HMO, you want to make sure that you sort of lend into the right people, because they're not, you know, for the right people, they can be great. So obviously they provide a lot of yield, but you also need the time to manage it, market and sort of deal with market terms sort of ones, because it can be difficult for people that are not experienced. So we'll look at it from that perspective in terms of experience, but also, you know, how they're going to manage it. If there's any void periods, what does it look like if they've got, you know, they might be on a fixed rate now, what if, you know, you come to the end of your fixed rate right now, you might be a bit shocked. So we'll look at all of that, we'll stress those portfolios to see what that looks like with a stress on it. So yeah, the underwrite really, I suppose, is around a wider financial position as well as the loan.
Right.
It's fundamental to buy-to-let loan. You're just looking at ICR coverage. Quite simple, you know, you get the valuation, you work out what your LTV is, and then you look at the, you know, the mortgage payments versus what rent they're going to get. Stress that, you know, that works. But what about outside influences? What about, like I said, what about their experience? What about their commitments that are elsewhere? So that's really been a big part of the whole approach that we've taken, both in terms of risk appetite we've got for those types of loans that we do, and also the you know, the types of people that we lend to and how we underwrite. So the main focus, I mean, at the moment, it's all about affordability. Most people in buy-to-let typically take 5-year fixes, so that's really nice and simple. You can do a calculation based on the pay rate. Well, now 5-year fixes aren't really sort of working for us right now in this environment. So lots of people are moving on to kind of you know, tracker rates. So you've got a whole different way to look at those. So there's a different calculation that we look at for those guys as well, just to make sure that they've got that backbuild in case there is any sort of movements on rates going forward. So those are the main focuses for us, really. Yes.
Sorry, very quickly. I know there's ability for 10-year fixes in for the docs that we've been reviewing at the moment. How many of those did you actually sort of write as part of your wider portfolio, and is it something that you think is still necessary to include as part of your toolkit as such for a borrower?
I'll leave that. Zero, we haven't written any on 10-year fixes.
And I think, you know, the current, we haven't done any. I don't, you know, we haven't had a product to that tenor ever, I don't think. I don't think we've ever had a 7-year product.
No.
I think what we've done, we've just discussed including it and having the flexibility in the past, should we want to do it in the future.
Market has consistently over the last 40 years, you know, by not taking long-term fixes. If you took a 10-year, there's no after 5, then it's a long way back to the borrower, right? But otherwise, they just don't sell. So.
Yeah, I was going to say, is that something that you happy to leave as a flexible product feature, or would you rather just not have it in there?
I mean, it was actually more thinking about the hedging side, whether they would have to work their tenors slightly differently because of the longer product. But we'll have a look, obviously, whether there's other protections in place around sort of the weighted average tenor. It's unusual, yeah. I suppose if it's something that you're not really going to be expected to write, then it's kind of an area of flex that is kind of a bit unnecessary.
In the market, there was this period where the curve shot up, but the longer term curve came off. And so some of our competitors were doing sort of 6 and 7 year fixes because they could offer a cheaper headline rate. And we couldn't. I think that's probably what the origins of this clause was, that we have some flexibility in it. To be honest with you, I would personally, when Adrian's shout, I'd personally be happy not to have it in. We've done 5 years now forever. But if we ever came to you and said, look, can we do a 6 year, right? This is what we're trying to accommodate. To that point, make sure we could get the hedging protection and all the rest of it. So I think that was probably the rationale. But
yeah, I don't think we'll definitely not lose sleep over that one in terms of, because we've obviously never done one. I think it's whether I agree hedging can be complicated, especially because that'll roll past at least one good deal cycle.
just go back to your question about the SPVs, May, that answered the question on the spills. Obviously, all the KYC is on national crime checks on the SPVs, as you said. So we do quite rigorous checks on all shareholders and all the rest of it. That checks. Yeah, and we also ongoing monitoring as well. Yeah. So if there's any changes to the structure in that foreign entity, then we're and sanctions checks, checks, Dow Jones, media checks, that kind of stuff. Yeah, so I mean the onboarding stuff that we use is extract. So you'll do that for both the company and the individuals. But and that's what we use for the ongoing monitoring around the SPVs. But if there's anything that we need to look into a lot more detail, then we've got something called Smart Search, and our compliance team use that for basis. Yeah, we do the backup with that. That's there's checks and flags, compliance pick up. Yeah, you can get a lot of detail on there where you can actually go in and actually see whether or not, because there's lots of people that have got the same name that have done bad things. So this does give you a really, this tool does provide you with a lot of detail. We clearly say, well, it's clearly not. Different places, countries of residence, all that sort of stuff. So there's a lot of tools that are available to us in that regard, as well as the usual things like ciphers, flags, will sometimes come up within credit sources.
And in the case of offshore, if you have them now, I think the way offshore forests within those structures, are the tools you're using able to pick up any of the information you need?
I mean, what we do is, if they're not resident in the UK, we don't have the facility to sort of, find everything when they're abroad, but we do use the security address for here, search them against, and then what that will do is bring up anything that they've got registered against them in the UK. We've got, obviously, we're putting into place sort of mitigants. So when we're lending to people that are based offshore or people that are foreign nationals, then we've got a kind of limited number of nationalities that we'll be prepared to lend to, and we've also got companies that we wouldn't be prepared to lend to.
And we require them to have held a mortgage in the UK.
For an
And a UK bank account for 12 months. So they've got to have a mortgage, which means they've gone through a lot of due diligence from a lot of regulated entities, and to have a UK bank account, we also have a similar amount of diligence attached to it. And we can't satisfy that, then we're not.
If you don't have the information, it's like, well, we can't do that.
Yeah, another thing that we started to look at recently is to insist that whoever they work for is kind of based in, the EU, the US, Australia, people that we can easily trace, rather than what we were finding that a lot of people that were working for companies that it's very difficult to kind of decipher exactly what they did. And if you've got people that are actually bringing money into the UK to invest in properties, to do that, so where's the come from, how do they do it, where's that built from? So we were finding that was proving pretty difficult to get comfortable at lots of instances, which is why we then put an extra layer in terms of who they're employed by.
Is that per shareholder?
that would be the individuals, yeah, as well.
Do you have a cut-off time? A lot of shareholders.
Unfortunately not, but what we tend to do is actually, there doesn't, for the SPVs that we lend to, it doesn't tend to be an awful lot of share. Occasionally you will, and it's a common theme on how you want to genuinely look into. Usually it's anyone who's only, goals are sort of 20%, at least 20% shareholder. But yeah, there's a higher level of diligence that's required.
BWRA and risk rates, the different categories, so they would come to the higher risk.
They still only form a really small part of our loan book, actually. Most of the foreign nationals that we lend to are based in the UK, just happen to be foreign. So you will have, what we term as a UK-based foreign national, where they've already got UK bank accounts for our buy-to-let. It's clear, you can see all of the information that you'd otherwise see through a UK.
It's a UK company.
Yeah, well, it's always be a UK company. So, yeah. I don't know if you want me to trot through any of these slides, or we just continue with the...
One other question, just in terms of under a portfolio level, do you kind of solely rely on what's provided by the broker or the app, or do you kind of go into company's house and kind of build
do that? We do ask them to provide us with a kind of portfolio of their properties, but as well as that, you can look at things on company's house, and a lot of the time you'll see information that's within the credit search or within things like bank statements as well. So you can clearly kind of align the two together and actually say, right, we've got something here disclosed, and we'll check back on that. So there are ways of doing it. On that point, we did recently introduce, our approach to looking at these things hasn't changed, but you can imagine the time that's consumed by looking at things like that, especially on larger valuation reports, for instance, on multi-units or HMOs. And so we recently started to use AI to read that information and then present the results to underwriters. So it's not making a decision, but it is actually doing all the donkey work, reading through vast amounts of information and summarising the key information to the underwriters. So that was formed, with heavy involvement from the underwriting teams. You can imagine this is the information that they're going to base their decision on. So that's something that we did bring in the last year.
Yeah, I would forward note on valves, still good valve, still touch it, still see it. It's just a very clever way of too fast picking up issues or rest of stuff, but it's still looked at. And then from the credit searches, the tech is amazing with the APIs now. Not only do you get the credit search, you get files off the company's house, searches against all of the different entities, and returns. You ever look at an Equifax report, it's like pages and pages of these little boxes. And they're mean, actually, to be honest, this is so much to go through. And it takes it all and summarises it. And so it gives the underwriters a really much easier way to see that information as a class, and more importantly, flag issue takers. We do test it constantly, we're looking for errors, etc., and it's only implemented after a substantial testing. It is a dual process with manual and automated for several months. Actually, the tech company behind it is a company which is totally separate from the conversations we've been having. It's owned by Cerberus, and the guy who heads that business up was the head of AI for the UK government for the NHS during COVID. He's a proper, seriously interesting guy, and they've taken the same tech and introduced it to some banks. So it's had a proper kicking. And I think we're the only UK lender about 5 receivables again. But it just has given us an efficiency in a process. It doesn't introduce any decision making. It's all done by humans still. And you see a valuation report, you just tap on it to, okay, this property is adjacent to, another type of property, click straight into the PDF of the report, you see all the detail behind it, all the comparisons. I mean, it really does help that efficiency, but at the same time giving the underwriters full access to the original document. Yeah.
We get all securities are physically inspected by valuers as well. We don't use sort of anything like that. So all physical inspections, we've got panel of surveyors that are managed by a panel manager for us. They make sure that the instruction process is all independent, so brokers can't interaction between brokers and valuers, and favourite valuers being used every time. So we took that out by having the panel manager manage all valuation instructions. What they also do for us is audit those firms on a regular basis. And on the instruction, they'll make sure that not only is it sent to the right valuer in terms of sort of where it is in the country, but the right specialties as well. Some firms, the valuers are able to do like a single unit property, but they wouldn't want to give that out value an HMO. So it's all that the panel manager makes to make sure that the right valuation instruction goes to the right firm. So Simon mentioned already, I mean, we lend off of the market value, but we also get the 90-day value as well, which is almost like an early warning signal. If there's problems in that area and things are taking longer to sell, then that will clearly flag up within a restricted resale period of 90-day value. We use the valuer's opinion of market rent as well for our ICR calculations. We get the most up-to-date appraisal of market rent to use in our ICR calculations.
And that's difficult post-COVID because the valuer requires comparables for any transactions. So we were quite slow coming back to market because we had to wait until the valuers could actually give us that data, sort of to rely on.
I don't know if you want to, there's a couple of other slides here. I mean, these are just sanction levels. We've got individual underwriters that are mandated to approve loans up to certain loan sizes. That's all dictated on the experience. We do regular audits on the underwriters' lending decisions, and certain size of loans or exposures will go to a credit committee as well, because we've got a lot of people that are repeat borrowers. So they'll come back, they'll have a number of loans with us. So once they get past a certain size, then that also has to go to the right sanction level.
You will look also at the aggregate, say they come for a new 500, you say, well, actually, on aggregate against Explorer, we end up at 3.5, so you will...
It needs to go to the right level,
okay,
so you've got the right level of experience and oversight at those loans.
How much experience does the individual need when they sort of together a level one sanction level as such? Have they got to do a significant period of training, shadowing with?
I mean, anybody is typically anybody we recruit into the sort of even the base level of underwriting would have had experience as an underwriter before, but they will have training first of all, so they wouldn't be let loose with a mandate of their own, at least until they're sort of usually it coincides with a kind of 3-month probation. We usually have a good idea about their skills as an underwriter at that point. Sometimes we set it lower, so I mean at the moment it just so happens that our minimum mandate is 500. We've had 250, 300 in the past, depending on the level of experience.
But then the process is that every single case they've got is signed off by a senior person, and then once that process has happened satisfactorily for a period of time, then it's submitted to risk committee with the recommendation that that mandate is then granted. So
they're regularly audited as well, so if there's any problems that we can highlight, we can actually force that mandate. And for instance, if people leave, we have people that go on maternity leave and come back, and clearly, we still need to make sure that they're able to set these on the right basis of policy changes, so we can kind of pause mandates for a period of time until we have to slide just, Alex says a little bit about ability, so that just gives you an idea on the left-hand side around, the different OPR levels. Things like HMOs, I mean, on that side you've got corporate and lower rate taxpayer, we expect 135% cover, higher rate, which is typically, if an individual goes for it in their own name, they're a higher rate taxpayer, they've got to hit 145% ICR. I think we probably might have a slide in this deck somewhere that tells you what our actual ICRs are, but usually on an HMO file, it's these those numbers anyway, because the yield. We do a lot of ALS. We don't have an awful lot of them on our book, but what we'll do on those is, because it isn't necessarily dictated by a kind of market rent, we will we will look at what they've earned like over the last few years, what the property's generated, but then we'll also do a back check to make sure actually, look, if you did have to put this on the market and put it as a buy to let, what would it cover? So we want to make sure that it does cover at least 100% of the payday. But yeah, which is, you know, we don't look at anything that would be on a holiday park, because really that wouldn't, you wouldn't be able to use it as anything else but a holiday. But we don't have we don't see anything like that. We've covered up valuations already. This was just a little page on HMOs if anyone was especially interested. We don't lend on, you know, huge student-let sort of 50-bedroom units or anything like that. The majority of what we lend on is probably, yeah, I mean, it would probably have started life as a Victorian or, you know, terraced house, and has gradually increased and been subdivided. They tend to be in areas where there is a huge demand for housing. Hence the reason why landlords have moved into this area now, because actually letting a 3-bed terrace out as a single unit probably won't make you as much as if you subdivided it into 6 units and you know, can get a much higher yield. So that's what ours tend to be, the kind of 6-bed size HMOs. But clearly you want the right experience for most of
the northern HMO still kind of the popular kind of
the northern, that one.
yeah.
We most of ours are actually North London rather than up north. So actually, we you know an HMO has got to be in the right place for its work really, because you know if you've got you know sort of lower density areas of the country, HMOs don't serve not demand for it. So the HMOs that we tend to see would be in high density sort of urban areas. So typically a lot of ours are in North London, zone 3, 4, where there's demand for housing and, you know, another sense of like London especially. No, these are the sort of most affordable things really people to move into. Similarly, you know, other areas in sort of certain parts of the country where there's a hospital nearby or there's universities as well, that generates demand as well. So they've got to work as HMOs, and that's why the valuation is so important, to make sure that you've got the right, you know, demand and that the valuer really sort of tells you what the likely demand is going to be and if it actually works as an HMO. There's various options for planning and licensing laws as well that they will have to comply with.
I think the direction of travel of our book and the direction of travel of the market are really well correlated. Again, you know, I think it's interesting. I think that on the last couple of transactions, you know, Stuart Simon and I kind of impressed the investor. I don't think there was a single piece of dialogue about HMOs in the last deal.
Well, S&P came up with a paper about 2 years ago, basically suggesting that it's nothing detrimental, but the opposite, because it just introduces a sort of almost like a bedrock of high cash flowing assets, which is you know really strong. Yeah, no, you know, it's almost that is the market. You know, it's definitely moved that way. But we will have northern ones in there.
Well, no, it was in the news. That's where that allowed to move.
Oh, I see. Yeah.
Okay.
There's also
yields are getting compressed.
Yeah.
I mean that would also be after that. You know, the point time we made earlier about our average loan size. You know, it could be older than that.
Yeah.
Share a funny story about that sort of geographic. Once when we first launched the business, the very first outlets, which you guys have been working with us on, and I remember who the investor was. I said, well, your concentration, you know, you haven't got much in the north, and I remember saying that, what do you want? If you want like £110,000 properties with £80,000 mortgages on them, you know, that's not us. Because let me tell you something, as soon as that property misses a beat, you're in negative, because it's missed the auction, you've got a big haircut, you've got all the professional fees. Alternatively, you could have a £400,000 loan size and, oh yeah, good point, and that investor and has invested consistently in outlets ever since. So diversification is a funny thing, not necessarily what you want.
We
Sorry,
Is there any more questions? Still had a question like that.
Just very quickly, the ICR, that's against stressed rate, is that right, across all your tenors? Or is that against the pay rate or the lower one?
Yeah, the pay rate for anything on a 5 year,
Yeah.
and it's done on for either something that would be on a 2 year fixed rate or a tracker, then it would be the higher of 5.5% and pay rate plus 1%. So it's a slightly different calculation there, and then those ICR minimums are their minimum requirements based on the rate.
Would it be possible to share the latest underwriting policy? Yeah.
Yeah, that would include that in there.
Yes.
And sorry, has that changed in the last sort of two, 3 years since we were last in the buy-to-let facility, or?
Yeah, I mean, we're always looking at any time there's any kind of volatility, I suppose, and there's a retreat away from 5 year fixes, we always start looking at the affordability again on trackers and anything that would be on anything less than 5 years. So we do regularly look at this to ensure that it still makes sense and that actually, from a affordability perspective, anything that we're calculating on those rates is kind of in line with what our expectations are on where rates would be. So that is looked at on a regular basis, and probably one of the things actually since inception that we've changed the most, I suppose.
Okay, and then this is simply based off the rental income, and you used to do top slicing as well, didn't you? Or you still do, presumably?
We do still do top slicing, not for things like HMOs, I might add, because for all the reasons I said before, you'd expect those to be thrown off enough rent to cover. In the instances where we do look at top slicing, then, I mean, first of all, that most of the loans are actually just based purely off the market rent. In the instances where we use top slicing, that market rent's got to cover at least 110% of the ICR, and the rest of it wouldn't necessarily be, isn't from things like any outside income. It's usually as a result of using excess income from their portfolio. So we'll also do a test on their outside portfolio. This is usually not to make up huge kind of gaps. It's more that I would not quite hit. So, is there income from elsewhere that we could use? And you can clearly see that in their portfolio, and you've already done a stress on it, and there's still an excess. That's typically when we'll use top slicing. So we don't use them on HMOs, we don't use them on holiday lets, and it would only ever be from their outside portfolio after we stressed it.
So I haven't cross-checked against the latest data tape, but I suppose if we would see cases where the ICR is below 125, we would assume that there is an element of top slicing there, subject to sort of 110 as a floor, essentially, against rental.
Yes.
Yeah.
It's never been a big part of our product range. We don't promote it as such. It doesn't take outside income like salary into account. We won't look at that. All the things you said. It's always been a small part of the business, but
sure,
we do it where it makes sense.
I thought that it was worth the question because more of the portfolio is focused in London and South East, where the property prices are obviously greater, and rental has perhaps not been able to keep the pace necessarily, but
even though values are higher, the more valuable the property, if it's not really been subdivided, then they don't necessarily work as buy-to-lets anyway. So actually, you need the loan to value will naturally have to come down, or the loan size would have to come up for it actually work. So there is a point really where something just wouldn't work, like a single unit, high value property really wouldn't work at any kind of reasonable LTV for an investor, which is why you don't really see experienced landlords coming to you with a property in Mayfair. Well, it just wouldn't work. So that's why there's typically going to be, an HMO in Stanford Hill rather than anything prime location, because they just don't work. But in terms of the investment.
Thank you.
Before we hand over to Ian, because Ian, I'll let you introduce himself in a minute, but let's obviously talk about the service in the portfolio. But is there anything else you guys specifically wanted to cover in terms of the credit underwriting? Stu? Again, if you think of something after, it's fine. We can obviously help.
Yeah, honestly, seeing the latest policy, that might trigger some questions, so just come back to us. I did an intro on your behalf, Ian.
Very good.
What did you say? I couldn't remember, so I made it up.
I always make it up. We've been seeing him here for years, and we don't know why.
You do, yeah.
How you doing, Gordon? So have you covered it? That's all on the operational side.
Only as much as I've mentioned that we outsource all our IT to vendors.
Okay. So a couple of updates on that. So so we're outsourced, and we're also, there's nothing on premise here either. We're all with the cloud based, so Microsoft Azure Cloud for everything, and that includes a couple of key platforms we've got, and I'll give you some updates on that. In terms of day-to-day running of the IT shop, if you like, again, that's outsourced to a third-party managed service provider called Pere. So they provide looking after all the infrastructure, from laptops to servers to all the cloud infrastructure as well, the Microsoft Cloud infrastructure. So, and they're here a couple of mornings a week, just doing local desktop support, which is actually really quite valuable for us, and that works quite well. They were also doing some of our cyber security work, so they had a fairly limited cyber operations, security operations centre in there as part of their proposition. But we decided, and equally Care, that's becoming such a specialist area now, as you probably see in your own business, that they were kind of retracting from that market because it requires heavy investment and heavy expertise and some really serious qualified people. So at the same time, we wanted to move into a more professional, extensive cyber security business with somebody else. So we went out to market actually on that one about September last year. The normal ITT, we had 3 suppliers. We chose one who are actually quite local to us, based in London here, who are a specialist cyber security organisation. That's all they do. So we've sort of signed up with them. We're spending a bit of money with them. We're really improving our cybersecurity sort of posture, as they call it, and making it much more professional, effective, and a lot of coverage. So just finished migrating the SOC from Curve to a new supplier called 6 Degrees, and they are now looking after all the attacks and all that stuff, which happen 24/7. So it runs a 24/7 operation in their business. So, and they're doing lots of other things with us in terms of policies around incident management, business impact analysis. We've just finished what's called a NIST assessment, which is the National Cybersecurity Framework that based out of America that everyone uses. I guess you guys, your corporate would probably be using it as well. And you do that to see where you've got gaps potentially, and everyone will have, and then what do you do about filling those gaps and improving your policies and procedures and stuff like that. So we just finished that, and we're acting on the findings of that at the moment. We're just also finishing off the preparation to do some penetration testing, which as a small business we've never done before. So it'll be internal, external penetration testing. And again, 60 days of providing that service for us, and they do all that with us. So that's quite a shift from where we were this time last year in terms of our IT provision has extended, particularly in the cyberspace.
It's one of the biggest single risks facing every business at the moment. I mean, we spent a lot of time as well training people about risks, watching out for it, and we continue to do that to remind people about that. So yeah, it is a constant developments, isn't it?
I
It's
think-
quite a significant increase in cost to the business. But it's not something that's discretionary. I think is how we see it.
I mean, we found that going out to the market to find a suitable partner, the guys at 60 Days are really, they're really quite impressive people. Most of them, in fact, not all of them, are all ex-GCHQ people. So they've been working, obviously, for the government on all sorts of things that they're not allowed to tell you about. But, and they work through the eyes of a hacker. They can all hack, probably have done in a professional career. So they know how these guys operate. The big thing they were saying just recently, just interest is that the AI models that are out there now can mimic what a hacker does, but 25 times faster than a hacker would do it. And they're saying, just watch the news over the next few months. There's a lot more coming that's getting done quickly. So, not good news, I suppose. But, so that was more about just what's kind of new in terms of our IT division, which is on the cyber side. On the platform side as well, we've got an update to give you as well. So we've got two key platforms here, which we license from third parties. The one on the left, that does all of the underwriting process from a broker, adding an application via the broker portal, which is part of the system, to submit a mortgage application to us, all the way through the underwriting, case management and underwriting process, through to completion and fund release, all handled in that platform. Second one, which is our servicing platform, which is a company called Phoebus, which you probably heard of, some of your clients, yes, would use it. It's very popular in the sort of mid-sized banking, small lender, the building society type market. It's been around for a long time, but it works, and it works very effectively, and it's got a lot of automatic processing as part of the capability that it has. So we use that very effectively for managing all post-completion servicing and arrears management, collections, etc. So it's been around for a while, as I said, but it's been fine for us. Both systems are connected at the point of completion, so a loan is boarded automatically from one platform to the next once we get to the end of the process. That's all done through API links, and the account's automatically set up on Phoebus, ready for us to start servicing, and that starts with a welcome letter, welcoming customer to Lenco, and off we go. Direct debit gets set up automatically to collect the first one 1 month later after completion, and off you go. That's how that works.
Can I ask? Just a question on the interaction between the origination platform and Phoebus as a servicing platform. You said that was automated. So does that mean that the loan can only exist in both systems? Does it move from one to the other? Who's got access to interfere there? This is, again, as you can imagine, with less background and fraud risks, but just trying to understand the system approach there and how that works for individual loans.
Yes, I mean, the key pieces of data from the underwriting process is automatically sent across via an API link to the Phoebus system. So there's no interference at the point of transfer. When our completions team get all the information from the conveyancing process that's ready to go and to be funded, that's what happens. And when we say that the loan has then been completed, that's the kind of button they would press, really.
Yeah, so I'll just add to that. It's a one-way valve, so what comes out of the Aprivo system into Phoebus is a subset. So you'll have a whole ton of data on Aprivo that is not relevant to servicing that loan. So we don't take that. We just take the relevant stuff that goes into Phoebus, so it's a subset. The data in Aprivo stays as it was at that point of completion, and then conferred to in the future by underwriters looking at further cases for that borrower or product transfers and so on and so forth. If we want to understand how the mortgage is being serviced, we have to then speak to the servicing team, say how's that account being conducted satisfactorily, and then we can add that to our decision making on any other lending that we give them. But it's from a data integrity point of view, there's no manual keying of data from one to the other with an API, and it's a subset, if that answers your question.
Yep, that does. Thank you for manual intervention.
Yeah, I think as well, like if you think about the world in terms of controls across the process as well, it's probably worth flagging that there's lots of segregation in terms of the way the journey flows, because like initially, Treasury, the underwriters start to key the cases, or they start to work through the cases that are keyed on by the brokers, and they do all the checks and all the stuff that Stu spoke about. At the point the loan's mature enough in the pipeline for us to ascertain where we might want to fund it, we assign the funding pool. And then the completions team that Ian referred to, they're responsible for managing the process, making sure that the right details are there, the solicitors everything's done that needs to be done in the solicitor's piece. And then once they're at the point where they think the loan's ready to complete, they then get into communication with Treasury and then say, look, we're going to complete the loan on X date. There's a spread, a kind of like completions queue that we all work to. And then there's separate four eyes checks on those loans at that point. And you then got a situation where the people who then enter the solicitor payment details into the system, e.g. the loan amounts, etc., are separate from the people that approve the loan dispersal. And also are controlled by something called a restricted template. So basically, there's only about, I want to say 10 solicitors that we can, 9 of us, that we can actually send money to. So if we've got a facility with you, and we're sending money from your pre-funding account, we've only got 9 places we can send it, and that helps to put a real kind of rigor and framework around it.
But again, none of the sort of treasury information is passed across to Steve or something like that. That's all just part of the originations process end to end.
But what does happen, and can probably give comfort actually, is just the fact that we've had all of these AUPs done, and those AUPs do read across loan docs, Aprevo, EBUS, data take, and they all.
It might be worth Rory just giving a bit of colour on the stat audit that happens across the company in terms of the ticking back on the assets.
So PwC will come in, well, they have been with us for the past few months, and basically they will look at the entirety. So we've got multiple pools, so each access program has its own code that's suited to all the loans and that. Same with the warehouses, and what we found over the years, quite interesting, they ordered the entire loan book, agnostic of the loan pool, and through that they'll pick up whether there's duplicates, etc. They also do the loan land registry check as well, in addition to the AUPs and another external auditor looking at that. And they will basically, the entire pool, on a sample basis, but for any one error they pick up, they extend the sample, and they would keep on extending the sample to the point they get 100%, for example, and then they would be happy with that if that was but they'll do the full end-to-end tracking. So the funds come in, the loans originated, they'll track those funds that comes in, will buy the loan, look at the loan going from pre-bid to pre-bid responsible data stage, which generates funds out of his border work. Then there's also the cash manager report, the investor report, and the warehouse. We have a cash manager, so all of the funds coming into transaction accounts or going out, etc. And there's a full risk control from A through Z that's then traced through, which is not too dissimilar to our own internal process from a finance perspective. So finance will look at it from a sort of a macro view, because we will look at how things work from completion scheme to treasury, into servicing and into finance, and there are sort of segregation duties across the various aspects. Well, maybe that, like Securitas now, they've got 10 loans with us, and they've got a manual, very few of them have a manual debit order, not the information, sorry, the manual payment, not a debit order. So they all just go and pay everything to one account. Certainly, if you might say that scan all collections to ensure that their products are correct, full code collection account. On a weekly basis, they all send across the government to finance. Our initial sort of point of contact and finance goes and verifies every single collection that they send across. To say, yes, we received that amount in that full code that you said, and you said should go to this. I'll go and check into the system which should it go to that full code. That gets sent to our senior finance manager who will spot check for payment flows ourselves to then approve that content. So I can order that correct intra-month, because that just means when we get to month end, the reconciliation just means we everything clear form. So and then put together come in and check all of that. And then just to sort of detect all the the last item the derivation between warehouses for audit. The 24th of March, the audit year is December 25 year in audit for all of the entities. So those are part of the entities. Those have been finished, signed, or that's already at company's house. You can go and check company's house, the financials are there. So it's within less than 3 months. Within about 2 weeks, all the warehouse will be done. So that's definitely done because it's a very clean audit. Next up is they're often got servicing operations, their segregation duties and all the agencies. All warehouses, so that means that in terms of what's in the pool, and where those loans are sitting, and the registration, etc., and the cost is 1.7 billion for the cost of so spark on this one off on the warehouse will be finished with that aspect of
I mean, just to finish off, I guess. So the one thing we don't outsource is our reporting capabilities within the business. So again, we are a Microsoft shop, as we call it, against cloud-based. We run Microsoft's Synapse data warehouse platform in-house or on the cloud, and that means we're dragging all the data, pulling all the data from the front-end system we just talked about, Simon mentioned as well, goes into our warehouse. So does all of Phoebus and a few other platforms that we have as well. We run HubSpot, which is the CRM system at the front end, and other things like even some Excel spreadsheet type things. So, and they're all date and time stamped every day, so that if we have to go back to a certain point in time in history at a certain date, we can do that in terms of recover to that point if we want, or look at things from back then.
How long is the history stored for? Is there anything originated today?
The history goes back to in our warehouse when we actually built the warehouse team. If you like, so before that we didn't have that capability. So it'll probably be 3 or 4 years now, 4 years, something like that, 3.5, 4 years. And we've got developers who work the database facilities that we have, and that's a full service to the business. We're at the point where we're actually doing Power BI dashboards for individuals and teams across the entire business. We've got heavy users on this, finance in particular, and the sales guys actually big on the broker side and looking at performance of individual business development managers kind of things and what their production slides and stuff like that. So that's all automated from the team. I guess one last point to mention is just we talked about Aprivo, which is our record system. We're probably 70% of the way to upgrading that platform to the next version of Aprivo from the same supplier. It's based on some newer tech. It is cloud-based already, but it's a new platform that delivers a whole bunch of other capabilities that we never had in our existing one, which is quite old now. The guys set that up when they set this up 7 or 8. And it gives us a whole lot of extra capability. It's much more easier for us to configure it as well, so we don't need the support of the authors of the platform. We're able to do things ourselves, which we will do progressively going forward. We'll probably end up with some software engineers to be able to do that, rather than asking the supplier to make the changes for us. It's kind of an open platform, all API'd up, and we can start doing more things with it. So that will deliver a bunch of capabilities that the business grows, which we expect obviously in the next few years. So that's a key project for us this year, our biggest project. Well,
The Microsoft China, the data warehouse, is that yours? Or data? Yes, rely on the Phoebus and
all the data for Phoebus and the people that's in the data warehouse, every cycle, yes. We pull it all in and then we get both. So yeah. But it generates all these other reports that you guys can talk about, data tapes and that stuff, all comes out of the warehouse.
yeah, that's the equivalent of Sprout data, I guess.
Yes.
Just kind of like looping back to your original agenda, I think the other piece you asked for there was sort of a general approach to the way we service the buy-to-let portfolio. I don't know if you mind just doing a few minutes on that, Ian, team, the approach, watch list, all of that.
Yeah, so the guys that we've got on board are all, when we hire people, they're all very competent Phoebus users. So we went in to hire people, they had to have a minimum of 6 years on the platform and be buy-to-let services people, and the Phoebus people as well. So these guys are very well experienced, know how this business works from a services point of view. So that gives us confidence that we're on top of everything. I mean, while it's not regulated, the buy-to-let, well, we just follow the principles of FCA regulations around residential mortgages, for example. But when it comes to things like arrears, you don't have to follow in a resident market. You only let's say call the customer twice a week or something like that, and all those kind of things. We don't have to do that. When we've got 99% or 98% penetration on our direct debits, and the small number of people we know them personally who pay by cash every month, and we know when they pay. It's not in their due date; it's some other time. They don't want to know their due date. All these people, so we know them very well, and that contributes to it. So most of the collection work is all automatic. So we use bottom line as a bureau. Phoebus generates everything automatically. It gets sent to bottom line periods before the due date on the direct debit. The order goes out, collect the money. Everything in Phoebus is marked as pay until you tell it it's not. So you only pull back the 2 or 3 failed direct debits that day, automatically drag and drop them into Phoebus, and it updates the account, and off you go. So it's highly automated. Our customers are, generally paying very consistently. It's great that the buy-to-let, because these guys are in small businesses. You get to know them when you call them up and miss payment. We don't want to miss payments because that affects their ability to keep borrowing. So you've got a great sort of like leader there from day one, and they're much more approachable. The answer is following to talk to you. So very low.
We have a process right from sort of soup to nuts. So Pere squirts the completed loan into Phoebus, completion letters sent to the customer, DDs set up, all that kind of thing. And then during the process of servicing the regular, they said monthly collection, but things don't go well. Then we need to get a hold of the customer, and most people do respond, some don't. And that's where that small population is where you spend all your time, because it's I don't know what it is, but we want to help. Our first thing is we want to help. But you've got to help us help you. The same thing. That's it. And then because we have a process, we have what's called the manual, which is our process template. We can issue ultimately a letter before action, and then we issue an on-demand repayment letter, and then we can issue point receivers, or we can become mortgagee in possession. So all these tools are available to us, and I'm pleased to say that the vast majority of times, if it gets that far, you get worked out and resolved, but occasionally they don't, and then you are putting receivers in, and you are putting properties into auction, and you are putting all those bits and pieces, but it's, we're very correct, it's just a tiny number of cases it's happened to, but the team have had enough experience to know how we do it, and we've got the right professionals, counterparties in place to help.
I mean, every Wednesday, pretty much all of Expo set on what we call the watch list every week, and we go through all the cases from people who are like 2 days past due or on that list, and obviously we're interested in the stuff that's 30 days that maybe starts to edge over. I mean, I think at any one month I might have one account that's more than 90 days past due, just one. But there'll be some greater than 60, the odd one, the same as greater than 30. That's when they actually into proper arrears after that, after 30 days. So, but we go through each case and we agree what the strategy should be if someone's in trouble, or what are the options, what we should do, and then we go and execute that, and then more often than not, that solves the problem and cures the case, and then we're back again next week with the same. So we'll be doing that for years now. So it's a real heavy focus on anything.
I think the culture of the business is very much, about, that's a bit like financial crime. We're all over it, and so servicing arrears culture is very much response, and it seems to work quite well.
By the translation of that chart, page 16 that we showed you at the beginning, that's why it's flat. Nothing's happened, because it seems that we're all attending that call. What is important.
Out of curiosity, and I appreciate the level of arrears is very low. In cases where you see an account in arrears, but it's a borrowers with more than one loan. Out of curiosity, what do you typically see? Would you see that it's a case of a partial payment across loans, or would it be no payment across all their loans if they speaking correct their arrears? What is the
That's an interesting one. You do see quite a bit. If someone's got 5 accounts, you don't pay any of it. But occasionally you see the paid one and think, well, what about the other 4? And you think there's been some reason for it. There's something beyond at the bank, something that's generally technical arrears. And even the ones that they missed 5, there's some reason for it. So we don't see much of that. And there's not a clear pattern of why it's happening, apart from the bank's done something wrong, or they have changed, they wanted to change the bank and it hasn't happened quickly enough. It's generally things like that. But if someone's in real trouble, they won't be paying it, and you see that all the way through, and then that's the time you have to take legal action. But it doesn't happen very often.
I think we saw it for New Year or something like that, but like it fell on a weekend or something.
Yes, all the time, yeah.
Within 3 days of people.
Yeah. People take their eye off the ball sometimes around Christmas and time.
For me, it's not. Again, it's not the income on the hobbies that safety, it's their business.
Yeah. That's why you're protected a lot of the time.
Yeah.
Did you cross the border? You can get down hard and come up, right?
You can do, yeah. So you've got a common PG, as long as the entity can be linked. So, as long as it's one SPV, you can pull it in on other loans, and we've done that before as well. So we can get the, so we had, actually also, it was a bridge, and there was a shortfall, and the borrower had 3 BTLs with us, which we were able to become mortgagee in possession to recover the shortfall in the bridge. So
those people. So they have to be the same SPV to.
Yeah, so the PG links all the way through, right? So regardless, but what I can't do is enforce on the if it's you know, Ian one and Simon one limited. Even though there's obviously it's a PG holder on both of those, I have to pursue him for his PG rather than saying to him, exactly. Yeah, slightly complex, but
Yeah,
what's
that's
not complex.
Yeah. And and that's part of the value in what as well. We will carefully consider the implications of that strategy before we execute it, thinking about it.
I think the only reason I mentioned it, there's two things, is that it's right at the top of the table, at the top of the house, in terms of the focus on that and the non-financial crime in particular, and increasing data, other things that we really think are drivers of losses if you don't get it right.
Has there been any cases where there has been a big negative impact, either through cybersecurity breaches or fin crime or anything along those lines to date?
No, I would say fin crime has been, we use the anti-fraud tools like Cycast, etc. we mentioned already. We reported some DSARs, we have made some investigations by the National Crime Agency along the way, so we've definitely come across them, but there's been no impact. We've had one fraud on a bridge where it was a rolled bridge, and basically it was a small balance, thankfully, but the conveyancing solicitor was the fraudster. So that's a very difficult one to mitigate against. So, but that's tiny. And we did have a cyber incident a year ago where we use a secure file transfer system, which is a global, it's an enterprise grade one. And I think the irony is that they're called SFP3 secure file. But the hackers got into their global code and were able to get access to any data that was sitting in this file transfer system became available. And that happened to a great deal of companies, and we got caught up in that and notified the ICO, the FCA. Both of them came back and said nothing more to answer, which is good. We had a big customer communications program for affected customers. And we've beefed up substantially in the cyber piece of it. So you learn from these things, but nothing that is that I can think of just right now is kind of be outside those two. That's
I think the only other thing around collections was this piece just to draw out, which was again really no surprise. I think right at the beginning of the kind of flagged the one important thing about it is simplicity. And in the top left hand corner, that's the kind of generalised bank account structure deals, and then the box at the bottom really just shows that each of these warehouse SPVs, they're all structured in the same way. We've got a transaction account that belongs to the SPV, and we've got a reserve account that belongs to the SPV. And if we want to transact on those accounts, it can only happen by us sending the payment instruction that the SPV approves and sends to the cash manager. So really, the interaction in cash terms is the bit that comes from Ian's team, which is the collections in, and that's an account that's going to be, that's in those names, but we sweep that money daily. So unless on very rare occasions, maybe money that comes late, then it's right the following morning, that happens every day. And the point Rory kind of flagged earlier, occasionally monies have gone in the wrong account. Well, the servicing team and finance team between them find those monies to get put in the right place. But the only other area we transact on the SPV is on the pre-funding account. And again, that outbound disbursement is via these restriction templates. There's a limit on the amount of cash that sits in the pre-fund, so from time to time we needed to do a lot of completions, we might get authorisation to either temporarily increase the pre-funding limit, or we might reach the transaction account on an occasional basis if you are funding a big dispersal. And the only other mechanism where there's an interplay of cash is the thing we call an EPT, which is an excess principal transfer. So imagine we've had 15 million of redemptions in a period, rather than draw another 15 from you guys, we all send a note to the cash manager with full visibility to your senior lender to say we're going to move 15, and the 15 will get moved from the transaction account refund. It's not being used ongoing. But yeah, as I say, outside of that, I think the accounts are all ring-fenced. Those collection accounts are linked to the divisions that Ian's been set up in Phoebus. And the Sun IDs are linked to those accounts. So even if we moved an account from Tolwood 4 to Tolwood 3, the DD would follow it. Yep. So it works pretty well, and we definitely proves, I suppose, the live case study is every time we do a book deal, we don't get millions of pounds all in the wrong place. It all follows the assets. So it's pretty robust, pretty well segregated. And I think the assurance work that Rory's team go through every year with people you see shows that actually they're on confidence that they think.
I think, Adrian, on this one, it's called a wet funding account, isn't it, rather than pre-funding, but the limit there is 20 million, is that right, for the senior ledger?
Yeah, I think so.
And then the actual use of that cash to originate mortgages, does it only go to solicitors' accounts, or could it go to a different account?
It generally only goes to solicitors. There's the scenario where you could have amounts that go to borrowers is if there's a product transfer with capital raise. The PT, you'll see, if I send you a bank statement, Phil, you'd see a bunch of things that said, I don't know, like some G4 collection account, T3 collection account, and it's where we product transfer between internal SPVs. What you will also see, what the Treasury team do, is you'll see 250k from X to Y, and then you'll say 15k to this person, and that's the marginal amount that's part of the capital raise. Because when you do a product transfer with capital raise, you're not sending the funds to the solicitor. So that's the only scenario.
Yeah, so this is super clear. It's very, very few and far between if we do a capital raise PT. But it's literally just that excess above and beyond. So if an arrangement fee is added to the loan, that's not a capital raise, doesn't go to the customer, it's just what it would be it only goes to the bank account that they've been paying from for the last 5 years.
Yeah.
Okay, no, I think I saw that scope of potential payments going from the wet funding account to a mortgage borrower's account. And so, yeah, I guess I just needed to track.
Yeah, that's it.
The purpose.
What you won't see is a main loan disbursement that happens in that way.
Yeah.
And it's where, I don't know, 95% is going SPVs and with controls and protections goes there. But to us, we don't, to Simon's point, they're not, the lion's share of PTs aren't cap raisers.
Probably when adding the segregation uses for all the information when they were borrowers, banks, access to bank statements, verifying it. All of that thing through to Treasury, the whole of the review process is now looking at things for the final of Adrian, and then we will go and say, okay, thanks for check the balance. So there's quite a few different teams involved.
Yeah, and as I said, the guys in the Treasury team who will input payments can't authorise them either. So you've got separate people doing separate jobs. But I think the multiple set of guys point is key.
I suppose our usual worries around a wet funding account is around the cash going to a solicitor and then the loan not essentially completing, and then you having to call back those funds from said solicitor. But I guess if you're actually advancing that cash to a mortgage borrower's account only under sort of product transfer basis, that loan's already funded with yourselves. So there shouldn't be such reclaim back on that fund. Yeah.
Yeah, that's right. Because the lion's share of it, there was a problem. It's from us to us, technically.
Yeah.
Or from an SPV that we have a relationship to another SPV. We have a relationship. So yeah, that's fine.
Thank you.
How many on time, Andrew?
25
through the agenda.
I mean, yeah, I was going to suggest, just going back to the agenda, but are there any particular topics you guys want us to kind of draw out, go into more detail? I think we've talked a little bit about the out the shelf, and you guys know about it, so we've done that, done servicing, credit. Badging checks.
Have you listed on the product specifics any particular differences on the buy-to-let side that differentiate your product from the competitors, or is it quite homogeneous with the rest of the market?
So well aligned. I mean, I think the areas that jump out to me are when you look at our public deals compared to a number of peers. I'd say our average LTV is a bit lower. We've talked about the kind of focus on professionalised borrowers, meaning we're more focused in London. But I think outside of that, our typical product setup is, typical product's going to be a 5-year fix with a 5% fee that sits in the middle of the table. And we sort of originate via the broker network we always have. So
I think that we have a weekly pricing meeting. We go through where competitors are, what our post-op margin looks like at the moment, pipeline as well as completed. We get a at the moment about 4 times a day swap update in terms of where cost of funds are, so we can take action quickly if we need to withdraw a product or. But fundamentally, what the brokers want, they want certainty of execution. Price is important, but certainty of execution, I would argue, trumps price. Simplicity. So if I go to Land Bay, they've got thousands of products, variations, and brokers just don't have the time and the focus to understand what it is. We have a very simple buy-to-let, tiered LTVs and loan size, really easy, similar for HMOs, similar for MUFBs, and a couple of loadings here and there. It's as simple as that. They get accessibility to quick decisions. That's a really nice formula. It works really, really well. So we compete probably not on price as much as many others do. In fact, we deliberately don't target. We try to sort of ease off by 15 to 20 basis points off where others are. That's kind of how we've always positioned ourselves.
It'll be interesting to hear the transition of same borrower from bridging to buy-to-let, because I think that has always been the plan. So presumably a high proportion of those bridging borrower do end up taking earlier.
And they do, and actually part of the underwriting process, a lot of the time there'll be, because the buy-to-let is going to be the exit, so they'll do a little bit of work to a property, getting it ready for a buy-to-let. So then part of the underwriting when we're doing the bridge is actually to see whether or not it would work as a buy-to-let. Clearly that's the yes. So yeah, I mean that is the most likely, and that's where our credit appetite is at the moment as well. Clearly, the sales market at the moment is, it's not as easy as it once was when you're sort of refurbing to sell. So most people are refurbing to buy-to-let.
a re-inspection of the property.
There would be a re-inspection, so I mean the valuation would be carried out for the bridge, and then if it is going to be on a buy-to-let basis, then the valuation would need to go back out and confirm that all the work's been complete and then what the market rent is going to be. So yeah, that's typically the journey. Yeah.
So would that original valuation have a special assumption? Or with a view for a buy-to-let and then they go back to concern?
Yeah, they'll give you we never lend off the future value, so it will always be the current value, so as it is currently. There are certain instances where we'll lend on a stage release basis, but again, that would require the valuer to go out, re-inspect the property, let us know that those works have been complete, then we can release the next amount. So we'll always have an idea about what the gross development value is going to be for that ultimate valuation at the end of the project will be, but we only ever lend off of what the current value actually is.
There's a definite correlation, say as we, we still haven't put sort of bridging volume to in the next following few months. You should see a follow-on into a buy-to-let production as well. Do you have a rough idea of that? We'd call it like the flow through the ring in terms of bridge 2A.
It's pretty decent, and we do track that. I can tell you what it is off the top of my head, but there's no obligation on the borrower to come to us for the buy-to-let, so we make it as easy as possible from a fees and cost point of view. And it's quite a successful product. People do like it. The broker likes it. The customer likes it because it's just easier. But ultimately, if someone's going to offer a buy-to-let which is 30 basis points cheaper over 5 years, they may well end up exiting to that lender rather than to us. But then they have to go through significantly starting the process from day one.
What we looked at and realised it didn't make any sense was creating a packaged product from day one. The problem is you can't do that transition. I can't tell you today, especially in the current market, what I think I'm within 1.5% what I'm going to charge them by let loan in 9 months. So what you, Simon's point, I think we do very well is we take away friction process, and at the end of the day, if you're already working with Lenco and we make you continue work with Lenco, it doesn't cost you much more money, you're probably going to stay there because you'll get to the point where you'll refi quicker.
You'll have noticed as well, we might have done on the chart that we had up there for mandate holders. So there's a certain number of underwriters in our bridging team that have also got a buy-to-let lending mandate. So the stuff that goes from bridging to buy-to-let will be underwritten by the same person. So you don't need someone to go over the same thing again and re-underwrite the case. So that's the sort of thing we're talking about in terms of the frictionless process.
Thank you.
New on topics.
I think the only bit of that is the ESG part.
Oh, my goodness, John.
You'll have a good time.
I feel nervous and Daniela on the call.
But we need to get it.
Okay. You're right. I think the main things around the ESG for us, firstly, so we have a group that meets at least every quarter, and what we did, even in the spirit of it being an ESG, it's the only forum that sort of meets regularly. We're going to put it, has governance over something in its work that's not dominated by senior management. So we've got from the wider business. So I joined that group. So there's Ali from finance, Rish from script team, and staff from script team, and one of my guys. And the purpose of that is to look to have regular airtime to ESG and just talk about. It's mainly focused on charity, conducting events. But the other piece that we do as an organisation is called GHG reporting that feeds into CABA. basically what we've done, we've engaged with a third party who describe themselves as a carbon accountant. On an annual basis, we submit a questionnaire around the business, and it looks at things like who comes in from where, how often do they public transport, drive, etc. And then looks at carbon footprint of the office, the building, that. So we end up with an annual figure that then feeds into Cabot's portfolio, but then feeds into us. And they're really the main areas to focus on ESG. I mean, controlling carbon footprint when you lease office space can be quite difficult in a way, because I mean, one of the ways you do manage it down is people who work from home 6 days a week, then you're reducing the new time. So they're the main things. I think we obviously contribute to, and one thing we start doing is talking to investors about sort of a little bit when we meet periodically with them, also about their needs in terms of ethics.
To be honest with you, it's the same sort of slide I put up at every single Atlas roadshow, and they all seem to go through okay. So, yeah, occasionally you'll get a compliance questionnaire, which is like 30 questions. You know, if we work through those, and we do that, we do a staff survey about commuting and all this kind of stuff. So there's a whole bunch of things that we do check and report on. But essentially for us, I think I'm a big fan of, we do products that are specifically geared towards more energy efficient homes. We do, but not for properties that are A's or B's already, because they're not making any difference. If you've got someone who's going to invest in the property and upgrade it, then yes. So Bridge to Let, great example of where you're taking a property that's completely run down and you're making it habitable. That's properly improving it, and that we can do something on the radar.
I mean, I think the last piece that's perhaps the most interesting, because I mean, it is helpful, as you said, do the GHG reporting in to feed through to Cabot, because then it means that you're already sort of loosely mindful of what their obligations are, and you know as much as I do that the ESG topic has become a bit more muted in the last couple of years for the ABS investor community, and whereas 3 years ago you might have had to answer a ton of questions at every roadshow, you're experienced enough to know that that's happening a lot less, and as long as you've got some basic information, including the EPC in the data tapes where available, then that kind of ticks most people's boxes. But I think for lenders such as yourselves, who are so focused on the professional landlords, then it is interesting to hear whether or not you're working either with them or with other trade bodies to try and improve the energy efficiency of the rental space, because that's where there's the biggest gap in the UK, in terms of the housing stock just isn't energy efficient, and asking, there's very few levers that the government has for the owner-occupied space, so it is more in the rental space, and in the rental space, whilst the targets are shifted as to what your minimum energy efficiency standards are, there is still some activity around getting landlords on board to try and take some action across the portfolio. So I was just really interested to hear whether or not you're having that kind of dialogue, or whether you're seeing those borrowers approach you with, perhaps some tweaks to the product range that allow for that energy efficiency improvements. Anything really that you're hearing or seeing is useful. It's not really about measuring your standards or whether you're ticking the boxes. It's just using your business to kind of tap into the rental space.
So one of the things you just said there about the housing stock, I mean, British housing stock is literally the leakiest housing stock in Europe. It is. And then the Midlands and the West Country in particular, it's even worse than other parts of the country. It's just the age of it, it's how it's constructed. And so one of the challenges you've got is that everyone wants to spend less money on their energy bills. They want to have less waste, be more efficient. But there's only limits as to what you can do. And so the last government proposed some legislation to have minimum standards, which then got shelved. This government has kicked down the road and is now doing something about it. But it's got no real teeth. So yes, we want you to achieve a certain energy efficiency rating by some point in the future. But we're going to put a cap per property of 10k. Okay, so you spend 10k. That's not a small amount of money, But 10k is not going to go that far. If you've got a terrace house in the Midlands somewhere, which is currently an E, what are you going to do? By the time you've looked at putting some windows in, you're way through 10k. So a landlord is obliged to do one set of actions, which is to comply with the law. And the second thing is, does he want to go or she want to go further than that? And that's going to be entirely individual. So how do you incentivise that person? Well, you probably could incentivise them by saying that here is a green product that is a cheaper rate, or it's got some other bells and whistles, and we've done that. And to be honest, it hasn't had a massive take-up. And the economics don't work for us to do something that's so meaningful that they're getting out and they're saying, I'm going to spend another 100,000 because my mortgage is going to be paid off for me or something. So it's not been something that we think we've been able to make a huge difference, nor does UK Finance. And UK Finance got particularly frustrated with the fact the government said, we're going to make this a lender problem. Well, why would lender, what can a lender do to change that? Which is why I use that example of bridge to let, because I do think that is an area precisely where we do make a big difference by enabling properties that are really tired and worn out to be rewired, replumbed, re-insulated, new windows, etc. And then comes out of the rent with a substantial increase. So that's what we do. But otherwise, that's my view on it. It just seems to be, until it's legislated for, landlords aren't going to put their hands in their pockets when the payback on an energy bill per annum is going to be hundreds of pounds, yet they have to spend tens and tens and tens of thousands. It won't shift their behaviour, I'm afraid. That's my view.
I think the circular thing was as well, that's why the government kind of kicked the can down the road with the legislation, because they also have the circular problem that we can't have a scenario where we've got fewer homes than people need to rent, and we're going to stop them renting the homes because the landlord hasn't been able to change the RTC.
Yes. If you don't have a minimum of C, then you can't rent it out, or where they can live. So I've doing a lot of backtracking on that. So there isn't a clean answer. I don't think.
I think what Simon said about the bridge to let piece is probably the biggest opportunity, though, because that's the area where actually people are going to do things to properties that can result in better EPCs.
Yeah.
Well, they're fine, aren't they?
Yeah.
I guess the traditional buyers end up being a very bit kind of built to rent, and the housing association gets a big footprint on new developments. I guess there's less newer home capacity.
We've always shied away from new build simply because, as a house, we didn't really like the new build tower blocks going up and the valuation volatility that's attached to that with the new build premium. So we haven't got a massive exposure to that space. But having said that, there are, as you say, institutional investors who that's what they want. They don't want to have lots of different diverse units. They want to have a whole site somewhere that they can control and manage more easily. The odds are it's likely to be a B, in terms of energy efficiency when it's coming out of the ground. So that's already been done. And to the point that was made earlier about UK housing, it's so poor that that's a 150-year-old problem already.
Energy prices keep going up.
Yeah. So you lag your tank, you put a bit of insulation on the roof. I mean, it'll get down to B&Q at weekends. It's not cheap to get this stuff. And to get someone else to do it for you, you can got teeth sucking going on. But yeah, it remains an issue, especially now with energy prices. So yeah.
Any other topics you guys want us to cover, or?
Well, the invitation is there. On the way back, okay, things that trigger in your mind, especially just come back to us, let us know.
They'll be back at Hotspur with more questions.
Very hard to listen to us for 3 hours, so I think I'll put down the button. Any more questions from online?
No, not for me, thank you.
No, I think that's been helpful. Thank you very much, Simon and team.
Well, thank you for taking the time out. We really appreciate it. I'll see you soon, I'm sure.
Yeah, great. Thank you.
Thank you.
Thanks, everyone.